story from Deal Street. Real estate giant DLF has entered into exclusive talks with Singapore's GIC to sell stake in its rental business. DLF could sell a 40% promoter stake in the rental business, which could fetch about 14,000 crores. The proceeds will be used to reduce the company's debt, which stands at over 24,000 crores. DLF CFO Ashok Tyagi spoke exclusively to CNBC-TV18, spelling out the potential timeline for this deal.
Today, the audit committee, based on the inputs of the bankers, the legal advisors to the transaction and the management, finally approved the decision to enter into an exclusivity with GIC acting through a foreign affiliate of it.
As you said, it will be a GIC affiliate. What would this affiliate be? And how much money or how much valuation is involved? How much money do we see coming in to cut the debt?
Okay. So it will be an investment affiliate of GIC. The roadmap would be that now that we will enter into an exclusivity arrangement with the prospective investor based on the approval of the audit committee today, there will be a finite time period within which we and the investor will hopefully conclude the definitive agreements, including the final terms and conditions and everything else. Once that is done, it will need to move for regulatory approval by agencies, specifically the CCI, and honestly, only pursuant to that will the transaction be ready to be funded.
Is there a time frame mentioned in this, which has been approved by the board? Purely for the purpose of exclusivity. I mean, now today we have got the approval to enter into an exclusivity arrangement with GIC, which in the next couple of days, I guess, we will. So that is when we will look at the finite time frame, but we expect the time frame to be a relatively short one of maybe 2 to 3 months to enter and to completely close all definitive documentation. DLF, after this transaction, does a QIP, which is it issues fresh shares, dilutes the existing holding of the promoter, and then the promoters infuse money to go back to 75%. I mean, that is one way to do it. Would I be, correct in the ballpark, in the broadly correct?
So Prashant, I think you are correct in the sense that that is one of the potential alternatives, is the way you articulated. We are obviously working with the bankers and the lawyers to examine all potential options to ensure that the money on a post-tax basis comes back into the company and we do not violate the public float guidelines. And if that means that a matching institutional offering be made, obviously it will need to be made.